For digital assets, I focus on Bitcoin because I'm so concerned about the fiat system. So having
Right.
spent my life in fiat, I want insurance against the fiat Ponzi. And Bitcoin, with its fixed supply and largest market cap in the digital asset ecosystem, I feel that Bitcoin is the best digital asset. But I don't ever advocate anyone to go 100% into Bitcoin. That would be irresponsible risk management. I don't tell other people not to do that if they have the conviction. But the beautiful thing about Bitcoin and its asymmetry to the upside is you only need to hold between 5 and 10% of your entire portfolio in Bitcoin to participate in the incredible asymmetric upside. And that's the way you manage risk, as far as my career has taught me.
Inflation is a buzzword penetrating the finance world, both traditional and decentralized. International leaders continue to debate whether current circumstances can be deemed a recession, while financial industry experts ponder a solution to the situation. As cryptocurrencies continue to become regulated, adopted, and pushed into mainstream view, questions as to whether digital currencies, such as Bitcoin, are the answer. Despite scrutiny toward Bitcoin's role as an inflation hedge due to current market conditions, Foss believes it is one of the most important technological and financial solutions to our looming debt crisis. Foss is a seasoned investor who has spent his career in the world of finance and has a deep understanding of the financial system. He has chosen to focus on Bitcoin as a digital asset because he is concerned about the fiat system and the potential for it to collapse. As a Bitcoin maxi, Greg believes that Bitcoin, with its fixed supply and largest market cap in the digital asset ecosystem, offers the best protection against the fiat Ponzi. He advocates for responsible risk management and suggests that holding between 5 to 10% of one's portfolio in Bitcoin is a good way to participate in the cryptocurrency's potential upside, while also limiting potential losses. Currently, the Bitcoin chart is showing an upward trend, with the cryptocurrency reaching a high of $19,000, which is the first time it's had that value in a few months. Greg finds this movement to be interesting and delves into the potential causes of this movement. He brings attention to the Consumer Price Index (CPI) coming in on target and how this may indicate that we are on track to achieve price stability, which is the goal of the Federal Reserve. However, Greg also expresses concerns about inflation and the Fed's monetary policy. He points out that inflation compounds, and achieving a 6.5% inflation rate after 8% readings in the past is not substantial, given that you're building on 6.5% with a base of 8%. He also highlights that monetary policy tends to lag by at least 12 months, and the rate increases invoked by the Fed over the last 12 months have been the fastest in the past 4 decades. Additionally, Greg mentions Jamie Dimon, CEO of the largest bank in America, who believes that the Fed might be getting ahead of themselves and that a pause may be warranted. We will now go into the video to listen to what Greg Foss has to say about the Fed rate hikes, Bitcoin, and everything happening in the crypto and financial space.
The reason I have some concerns, well, twofold. Firstly, people need to understand that inflation actually compounds, right, Paul? So achieving a 6.5% inflation rate after 8% readings in the past, that's not that substantial, given that you're building on 6.5% on a base of 8% to begin with. So, we could go 8%, 6.5%, 4%, 2%, -4%, -6%, and you'd still have a positive inflation rate over the last 5 years. And this is not good. So we need to understand the mathematics first. And then second, and most importantly, monetary policy tends to lag by a period of at least 12 months. And the rate increases invoked by the Fed over the last 12 months have been the fastest in the past 4 decades. So we've raised rates at a second derivative, or the rate of acceleration of the rate increases has been second to none over the past 4 decades since the Volcker area. And I think there's a lot of uncertainty as to how that will actually play out. I'm not the only one, and most people shouldn't really care what I say, but I think Jamie Dimon is saying the same thing. CEO of the largest bank in America, he has data that he's privy to data that no one else is, and he believes the Fed might be getting a little ahead of themselves, and perhaps a pause is warranted. But I'll just, perhaps paraphrasing Jamie Dimon, we're by no means out of the jungle or out of the woods yet, in my opinion. I anticipate a 25 basis point move or a pause. So I don't think 50 basis points is on the table. But that being said, now listen, who is Greg Foss? I am not an interest rate procrastinator. What I like to look at are things that you just mentioned, things like credit spreads, where I've spent my entire career as a distressed debt trader and a junk bond trader. Those are far more telling than a 25 basis point increase on top of, and this is key, on top of a 4 3/8 increase so far. So, it's, again, the magnitude of the increase, the acceleration of, 475 basis point increases in a row. It really doesn't matter, in my opinion, whether we go 25 basis points or 0 basis points. It's what we've done in the past and waiting for that to trickle through to the economy in real time, which will be reflected in credit spreads and volatility and other risk measures in the markets. Look at the difference between things like Capital One Financial.
Yes.
So that's lower, that's lower quality credit cards versus something like American Express or whatever. Just look at the stock price performance of them, and you'll get an idea that the concerns in the market for the difference between credit to the more privileged, we'll call it, or the more affluent versus credit to the less privileged or working class. And I'm not trying to parse the population, but that's the reality, is how the credit cards are distributed. So be very careful about drawing a blanket sort of conclusion. They might be going out giving credit cards to their primary clients who can still afford credit cards, but there's a lot of clients that are absolutely maxed out anyway. So I would not be out there as Capital One Financial being excited about giving new credit to my clients who are already way underwater. It's
exactly
just a recipe for disaster.
In conclusion, Foss, with his wealth of experience in the finance industry, also has a keen eye for the current market trends and is especially concerned about the state of the fiat system and its potential for collapse. He believes that monitoring indicators such as credit spreads and risk measures can offer more insight into the market than just tracking interest rates. Also, he points out a concerning trend where banks are aggressively seeking new customers, which could indicate that many are already reaching their credit limit. He also points out the difference in credit accessibility between the privileged and less privileged segments of society and advises caution when making investment decisions. Overall, Greg emphasizes the importance of staying informed and being mindful of the current market conditions in order to make sound financial decisions. We have come to the end of this video and would like to know your opinions in the comment section. Also, endeavor to hit that like button, subscribe, and always turn on notifications. Thanks for watching.